traders, welcome out to your currency midweek for December 14th. Corey here with you, and it is Fed Day. So we're going to trade the FOMC meeting together. Let's jump in here. Quick reminder, let's make sure that we follow our own trading plan. Just because the trade's right for me doesn't necessarily mean it's right for you, so make sure that you follow your plan. So let's take a look at the markets. We've talked about this a bit. Really haven't changed this since last week. We're anticipating a little bit of a choppy environment. I called it last week. I said it'll be volatile sideways. What does that mean? Big up days, big down days, but really going nowhere. And that's kind of where I think we're at in terms of the context. You look at the price action since last week, and we really haven't moved much. It's been volatile, but we're kind of spinning our wheels a little bit. Today, Fed Day is likely to create some volatility. Again, I'm not sure that we're really going anywhere, though. U.S. dollar's been in a downtrend, and here is something pretty important. Well, last week it had bounced perfectly on 104. This week we're piercing that, and that's a good thing in my mind. It gives a potential setup. This is kind of something that I talk about a lot, where when you've expended a lot of your energy to get to a key level, a level that everyone's watching and everyone's paying attention to, and then you try to initially break through, there's usually kind of a false move to it. In golf, they call it a false front, where it's kind of, you think you're going through and it's perfectly fine, and then it falls apart, right? It comes off. You hit the ball onto the green, and then it rolls back and rolls all the way down the hill. And so kind of that type of dynamic, where I think we're in that quote-unquote breaking of what should be support. That's what a lot of people are panicked about. And instead, it's kind of like a trampoline. You're just pushing into the trampoline and should spring back for a trade. So for a trading setup, it's kind of interesting today on the Fed meeting. The Japanese yen, I think, may have created, we might be in a dynamic where there's a major shift taking place from QE to QT. And if there's one asset in the currency markets that could benefit most from that, it would be the Japanese yen. So potentially, I mean, there's all sorts of possibilities, but when you look at how much the yen could go higher, if interest rates stay high and elevated, and there's some shift in policy and so forth. I saw a stat that suggested that banks in Japan have risk upwards of to $1 trillion. Yeah, you heard that right. Over $1 trillion. Well, that's kind of a worst case scenario, but when you think about the possibility for even just a fraction of that, a shift in policy and the way that markets are expecting the yen to trade, it could be gigantic. So I think the yen this is something that I really emphasized last week, and have really turned to believing that we've probably set a significant low. Wouldn't shock me if the low in the Japanese yen is set and maybe we don't trade below it for a number of years. I mean, that's a real possibility in my mind. That seems kind of crazy to say out loud, but it's a real possibility to me. British pound GDP, a little bit better than expected. In the U.S., they cheered on that the inflation rate was lower than anticipated, came in at 7.1 versus 7.3. And in the UK, same thing. A CPI number that came in a little lower than expected. And the markets are kind of taking that. The reason the US dollar is selling off, or at least one of those, is positioning for a Fed pivot, right? The idea that essentially with inflation coming down, the Fed can ease off of their interest rate hikes and those sorts of things. And so the dollar, which had been booming during the period where the Fed was aggressive, now it started to price in and easing off. And it's been doing that for a couple of months now. So we pinpointed the exhaustion high pretty well. Now we'll see if we're at more of a bottoming point on the dollar, at least for a trade, if nothing else. As you look at price action this week, pretty good risk-on environment. The S&P Crypto bouncing, gold up a little, oil up a lot. This is after a week where oil and energy prices were down a lot, so kind of a shift from that standpoint. As I look at the S&P 500 chart, again, we really aren't going anywhere, right? When we talk about a neutral market that's volatile, that's essentially what has happened. And where I saw it as moving to neutral was here. This was the exhaustion high. The same way that this started the race. See this huge bullish candle? I didn't highlight that very well. See this huge bullish candle down here? To me, that's the race beginning to the upside. This huge bullish candle is a sprint to the finish line. And so what do you do when you're exhausted? You kind of collapse and take a breather, right? Initially you drop back and then you go sideways, and then there's probably another drop coming. But for now, we're in that sideways. The markets were geared up. There was all this volatility. There was all this, these emotions involved. And to a certain extent, it got overdone. And now we're kind of in that calm phase. So I don't see any changes within this. I mean, could you break out temporarily to the upside? Sure. Could you break down a little bit into year-end? Sure. But neither one of those are likely to have a ton of follow-through. As we look at currencies, really this week, it's been a dollar story where we sold off below 104 on the Dixie. And that presents, some people might look at that as a short setup. I don't personally. I think we're in that kind of squishing into support, using it as a little bit of a springboard. So I kind of like that it traded below 104, trigger those stop losses, get people really geared up to thinking that the dollar's about to keep plummeting, and it should spring back here in the near term. Bitcoin, Ethereum, some of these crypto markets rebounding this week, have rebounded a bit. I mean, it got to its worst point a few weeks ago, and it's been rallying since then. So as we kind of make sense of this, as you just look at the technicals on the market, you'd say, well, but we're above the 20, we're above the 50. Yes, but we want to put context. When I'm grading something, I don't just say every time you're above the moving averages it's great and every time you're below it's bad. I more look at the context and say, okay, whether you use Elliott wave and you try to figure out where it's at within its waves, if I feel like this is its fifth and final wave, even though it's below the moving averages or whatever, does not mean I'm going to keep shorting it because I think it's at the end point, right? Hitting a stage 4 exhaustion, well, it's going to come back up here in kind of an ABC fashion. So do I want to short in here? Heck no. So we've got to put context around things. And to me, the context around the markets is one where, yes, we've corrected up, but that correction is still setting a lower high on a longer term basis. And really, if you look at the correction, it's kind of an ABC style correction within the downtrend. So to me, it still makes sense that while I am neutral in the near term and think it'll just be a little choppy, and I kind of almost expect it to spike up here a little bit and then come back in, right? Just temporarily push above the trend line. And maybe that's what happened yesterday. More than anything is just kind of, maybe it's already done that. So now we just head a little lower. But ultimately, I think the next significant move should bring us back towards here. Now, back towards here is where the rubber meets the road, because then you could set a higher low, kind of a head and shoulders bottoming point, or do something along those lines. But I'm not so much worried about the markets getting away from me on the upside. I think there's still corrections to come. As you look at international markets, a little bit favorable to U.S., a little bit stronger than. That speaks to the U.S. dollar weakness, but well, I wouldn't expect the dollar to go down significantly from here, so I can't really pound the table on those. And then like we talked about a few weeks ago on the Sam Bankman-Fried FTX crisis, right? Fraudulent happenings. Well, That was kind of the bottom in Bitcoin and crypto. You got the spring back, and now we're just in this tight consolidation. Not a lot of energy either way. Ultimately, I would anticipate, I'm not one of those ardent bulls that's like Bitcoin goes to 1 million. I would anticipate that a lot of the bloom is off this rose, unfortunately, that these are going to act similar to a lot of the other risk assets. And when you have massive money printing, and we had historic trillions and trillions of dollars of money printing, that is going to find its way into a lot of different assets, and the assets that are most popular that people are piling into during that phase were the crypto markets. And people were inventing new coins and they would run up. They were even making up coins that were a joke, like Dogecoin. It was meant to be a joke, and it grew to billions and billions of dollars of value. So that's what happens in bubbles, is basically euphoria and just stupidity, really. And so I think the bubble is burst, so and I would anticipate a lot more downside ultimately. That's my take on it. As we look at the rest of this week, it's still pretty full of events. So we're right here in the Fed meeting, right? So you got the statement that comes out in 20 minutes, 15 minutes. And then you've got the press conference afterwards. And a lot of times there's two separate reactions. In fact, the last Fed meeting, we had a good trade going, right? And we took profits on half of it, and it was working really well. And then the other half stopped us out on the press conference. And I mentioned that during class last time. I said, look, sometimes you'll get followed through. A lot of times it'll be complete 180. So could the markets rally on the Fed statement? That the Fed statement was a little bit more dovish and accommodative and so on. And then the press conference start, and he says, well, we're still at 7.1 inflation, and our work's not done. We still got to continue. And all of a sudden the market reverses. The way that they say things, the market just takes, frankly, overreactions to it. So those don't always mesh. We've got employment data out of Australia. You'll notice that a lot of events are packed right here this week, and then it gets quieter as you get into closer to Christmas. But this is why this week is just so jam-packed. Swiss National Bank, the Bank of England, the ECB meeting. You've got more data out of the U.S. You've got the ECB press conference. You've got flash manufacturing, German services, all of these different numbers in Europe, in the UK, and in the US on Friday. But, I mean, look at it. Central bank meeting, central bank meeting, central bank meeting, central bank meeting. It is an environment. It's probably, frankly, the last week you can really trade and have catalysts like this. From after this week, volatility will probably still be there, but liquidity, the amount of volume that's traded, will dry up some. And that can create some wildness in markets. So you're going to have to be more careful after this week, trading into the rest of the year, because in many cases, a lot of shops will close up, a lot of trading will be done. This is kind of the big finish. This is us hitting the finish line on 2022. You think about in the U.S., there's really nothing for the rest of this year. We've passed the CPI now. We've passed the central bank meeting. We've passed non-farm payrolls. I mean, essentially, this is it. This is the finish line on 2022 economic events. And then as you go into the new year, it'll be volatile, choppy, low volume, a lot of different things that are not always great for trading. Now let's come over and make sense of a few things. So maybe to start, what I should do is show the dollar index. That might be the best way to go about this. So let me pull up the dollar index really quick here. And the dollar index is actually a little worse than what you're seeing here. This is a day late. This is end of day is what EOD stands for. So it's not showing today's price action. But if we go back to 104 and just show, I mean, if I go back 15 years or something, you can see this 104 level. It was a key, I mean, it was the top in 2016 into 2017 right there at the start of the year. It was the top in 2020 on COVID for the US dollar. And this is called the Dixie, right? One of the most heavily watched and traded. Well, you can see we're below 104, but it's even worse than that because this is as of yesterday. And what's happening today is more selling. So if I go to UUP, stack a little more selling on today, and the dollar index is down there at 103, ish, a full point below 104. So we're seeing some continued selling. And again, as you look at the dollar index chart tomorrow, it's well below 104. So is that a breakdown? Well, I don't think so. For me personally, this is more of an exhaustion candle into yesterday and today. It's kind of a final phase. Now, I suspect, I mean, today's candle is not going to be massive size unless the Fed fuels that, which would really be good. If you get an expanded range, a much larger candle than normal on the downside, then it looks fantastic. The same way that this race began to the downside with big selling pressure back in here, and you could even argue back in there, this would be a big grand finale type of finish. And the fact that it's kind of squished below 104, triggering all those stop losses and so forth, would be perfect. So what I would like to see is more US dollar selling initially on the Fed meeting. The dollar spiking lower as the announcement comes out. And I would be tempted to look to buy that, to basically fade that reaction. Now the question is, if we're buying the US dollar, what do we want to go short? And for me, it's Aussie and Kiwi. Those are my candidates, frankly, for shorting. Could you short the euro or the pound or something else? Sure. But I kind of like the Aussie and the Kiwi. It gives us a little bit more risk off, which I feel like makes sense, big picture, kind of outlook and expectations. It also, the Aussie and the Kiwi look like they might be a little bit opposite to the US dollar in terms of just the way that they're kind of creating maybe could be creating exhaustion highs, the same way that the US dollar might be kind of setting a little bit of an exhaustion low. And the problem with playing exhaustions is a lot of times it takes a while to play out. It's not like it all happens, in a flash and you can pick the top or the bottom perfectly. So we're trying to be pretty precise around something that doesn't always have a lot of precision around it. But if I look at, I mean, the Kiwi specifically, Aussie hasn't really rallied as much as the Kiwi. But if you look at the Kiwi yesterday, just kind of a long upper shadow. Those are oftentimes at a high point. The candlestick size overall was larger than on average. And so it's like a mini kind of exhaustion. It's just a temporary reversal and ultimately is kind of turned into a little bit of a sell, a little reversal setup there. So it's kind of my preferred. I don't trade the US dollar against the Kiwi a ton. Kiwi's not usually like right at the very top of my list, but it is a little bit here. And so if I look at, let me go pull up this chart together. If we look at Kiwi versus USD, so I'm kind of playing this as though yesterday was the exhaustion and what we should not trade beyond. Today, I'm kind of playing this as a little bit of a reversal, saying, okay, let's try to kind of play this for the dollar setting a low and the Kiwi setting a high. Now, if I come into different time periods, I mean, you can kind of see that exhaustion boom, and then it's just a little consolidation here. That exhaustion thrust, and then a little bit of a give back and so on. And the 1 hour is pretty interesting in that we basically come into this really, really tight range. If you were to snap Bollinger Bands or something on this, those bands are really, really compressed. And so volatility is kind of compressed into this little, window. There's a couple of ways you could do it. I mean, we could fade a reaction if it bursts up here, try and short it. That would be my least favorite in this pairing. I would actually be rather doing that against like maybe the euro. So if we get the reaction we don't want, I might go to Euro USD for a short to fade the reaction. On this one, I'd really almost just like to see it break down initially, and then maybe a little choppiness in here, and we look to short it on the small bounce. And it might happen within, literally 30 seconds, right? When the Fed meeting comes out, a lot of times there's a volatile reaction. So here's Kiwi US dollar on the 1 hour chart. Look at how the Bollinger Bands are squeezed together. And I want to see this. We're a few minutes away. What are we, about 5 minutes away? I want to see this currency drop. So we want a red, basically, and then just to play some little choppiness. What I would do, and again, I'm going to be trading on a different screen. I don't trade on this particular platform here, but let me show you what it would kind of look like. Why is that not wanting to cooperate? Okay, so let's just stick that right in here somewhere and have it ready. So we could basically have a short, and you just put in however much you're trading, say you're doing 3 lots or whatever, at 64.46. You can have a stop, or you can have a bracket, or you can have all sorts of things, but I would have some sort of prepared order, in essence, to take profits and to stop yourself out. And we'll just kind of drag these around where we want them. So my stop, I'm really not giving it a lot of room. I'm probably going to have my stop, in this area. That's only 20 pips away. Target-wise, I think we can get quite a bit more aggressive on it. I would think that it should come down here into this chop from before. And so realistically, a reasonable target is just down towards this choppy area where we would probably consolidate something, big drop, and then it just gets choppy in here, and I would probably take profits in that zone. Your reward to risk, if you think about, if you were to get short somewhere around 64.46 and target a move down to the 63.88-ish level, you've got about 58, 60 pips of reward for about 20 pips of risk. So it's in the neighborhood of 3 to 1, very favorable on the risk to reward size. Just because you have a short ready at 64.46, that's the worst you could do. If I see this drop and then it kind of pops back up and I trigger my short at 64.46, if it's currently trading at 64.50, it'll fill the order at 64.50, 4 pips better than what I expected. But I like to have orders out there and kind of ready so that all I have to do is hit this transmit button and that order executes. As soon as it hits my price or better, it executes. And I don't have to go through the process of pulling an order up, getting it ready, putting on my stop loss, that sort of thing. Again, we're fading Kiwi USD on this. The Kiwi specifically looks a little exhausted on the upside. We think the US dollar's creating that little exhaustion low. and it's good pairing for that. If the US dollar just starts to sell off, what would happen here that would look good is the dollar rallying and the Kiwi falling. So if this falls as expected, kind of plunges initially, I think we move forward with this game plan. If it doesn't, if this chart goes this way right out of the gates, that means the US dollar is weakening. Then, first of all, we've got more time to go and consider, fading the euro or fading one of those other currencies, maybe even fading the Kiwi. We could consider it, but this one I'm less apt to because I feel like it's kind of a coiled spring. So I'm not really going to fade this one. If I was going to fade something, actually Aussie, we could fade. Euro USD, again, we could fade that potentially. But that one would be less urgent. This one has a little bit more sense of urgency. So it's the one that I want to watch into this event because we might be transmitting pretty quickly. Yeah, I mean, stop outside. The reason I put my stop up here was just to get it above these candles in the consolidation. If it falls, kind of chops around, and I get triggered, it should not proceed back above those highs. And if it does, then the fall was a fake move, and we're in the wrong trade, and that's what a stop loss is there for. Remember, we're only triggering this order, transmitting the order, if it's acting correctly and if it's starting to kind of plunge to the downside. So we'll see here pretty quick. What we're watching for also is energy. It should move rapidly down. Like you're watching this and next thing you know, it's boom, it's just spiking downward violently. So here we go. Let's see. We're about to get a reaction. You can see it just kind of creeping up a little into the announcement, but you have not seen a big reaction here. It's creeping up, and this going up is dollar going down. Okay, see the plunge? We can transmit that order in essence and be ready to get filled if that was an energy spike. That's the dollar rallying. So now you're looking for it to trade right back up, just like it's doing right there. Right back up into that zone of where we want to get filled. And it just missed me. I don't know if you guys got filled, but I am not, unfortunately, in the trade. See if we can, just needs a little choppiness there. And it's pretty darn close. I mean, there we go. So anywhere in there, I mean, in the 64.40 range is basically kind of what we were talking about. That's basically where we want to trigger the price. So if you did not get filled, right around those levels, as you see it kind of chop around there, I think it's a reasonable trade. If you want to tighten up your stop a little bit, instead of risking 20 pips, you're now risking 25 or whatnot. If you don't feel comfortable with that, fine. But you can see the reaction, and now we're starting to get that follow through. So it's the right idea to this point in time. Now, a couple of things to consider here. If we come down again, I'm kind of looking at, 63.88-ish, just kind of in the middle of this range is what I would expect to be the target. If you want to start looking at this, lately I've just been taking profits on everything. I haven't been trying to hold half and leave half on for more and so forth. I've just been basically taking the whole thing. We're not seeing a lot of follow through. There is some choppiness in the markets, etc. So I would probably do the same personally. Just as you plunge down here into this area just below 64, I'd probably take profits on all of it. If you are inclined to take half off, you still want to take half off as we kind of get down into that zone, and then tighten up the stop on the other half. But again, I'm not seeing a ton of follow through, so I'm more inclined to just take it off. Yeah, good question. So the reaction here is dollar bullish, right? The Kiwi's selling off versus the USD. And the dollar triggered a lot of stop losses going into the Fed announcement. That push below 94 on the Dixie is significant, and it's that fake out move we often talk about where you squish into, and seemingly it's kind of a false type of move. It seems like you're breaking support in the dollar, but what it's really doing is just that kind of the stupidity of the markets. It pushes through, triggers a bunch of stop losses, creates chaos down there, and then it springs back the other way. So I always think of it as a trampoline. When you land on the trampoline gives and it pulls down, but then it springs you right back up. And so it really sets a good short-term trade into today because we're at the bottom of the trampoline. We kind of pushed down through that and triggered a lot of stops yesterday and today. Sets up a nice little, surge and reversal that way. So it's probably going to be a little choppy here. It's probably not going to get down there towards our target until next hour. And that does present problems because we've got a Fed, discussion in 30 minutes. Now, I would expect them to still have a little bit more hawkish message that we're not done yet. So theoretically, that should be okay for this trade, but you just never know. So that's going to be the real wild card here is going to be their, whatever Powell says and the way that he words it, you'll see some reactions in the market accordingly. So that is a bit of a potential problem, but so far we're kind of seeing the reaction that we would have expected. All right, well, I think it was pretty quick and easy. It did what we expected. You got the surge, you got the little choppiness. It did not, by the way, hit the initial price. So if you didn't adjust your price at all, you're probably not in the trade, I don't think. If you adjusted your price up there when it kind of got in that 64.40-ish range, you could be in this thing. But I wouldn't blame you either way. I mean, if you held out for your price and it just didn't trigger, you cancel that order and you say, okay, that's fine. I don't have to catch every one. We had the right thesis, the right idea. I didn't catch this one. If you did happen to get in, you don't want to risk too much. You can kind of tighten the stops, do what you need to do, but don't. I would be inclined to start moving down the stop loss sooner rather than later. Again, I'm still worried about just kind of the choppy nature of things. So schedule for the rest of the week is pretty packed here. We've got trading FX off the charts. That's going to be sent out. We're going to trade the ECB meeting live tomorrow morning. We're going to send out our daily recap. And then this weekend, we'll send out the currency trading room. So ECB meeting tomorrow morning is the next live event. And we'll be meeting together at 8:30. Well, I think it's actually 8:15 a.m. Eastern Time, 15 minutes prior to. So I believe the class start time is 8:15 a.m. Eastern Time. Hope you enjoyed it. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.